What's up, family? I'm Emmett Combs. Today, I want to discuss this 50-year mortgage. I want to talk about what the proposal is, why they proposed it, and how it changes things. All right, let's get into it. So what's being proposed is now the Trump administration is looking at implementing a 50-year mortgage. And the goal behind this is to create affordability in the housing market. Right now, we're sitting in, well, we have, I think it's the fifth or sixth consecutive month where we have over 1 million properties of inventory, 1 million homes of inventory on the market, right? This is the first time in history that we've had so many houses on the market. Home sales are down back to the 2008, 2005 numbers, right? So prior to the last big housing crash of 2008, that's where the home prices or the home sales have dropped to. We're like recession in the housing market type numbers. Of course, we've seen where the Fed's cut interest rates, right? 0.25% last week or so. And we've seen what that did to us. It did absolutely nothing. As I mentioned in the last video, the Fed's cutting rates has zero correlation to the actual 30-year mortgage market, right? That's the 10-year Treasury yield. That's what reflects the mortgage rate. So with the Feds actually cutting interest, I'm gonna show you how it works. If you've noticed, if you've been paying attention to the interest rate market for the 30-year mortgage, interest rates have actually gone up, increased since the Feds cuts rates. This is why it's a better example of how that doesn't fix the housing market crisis, right? It doesn't fix the affordability crisis with the Fed cutting the interest rates. Of course, it will over time, but immediately, no, it does not fix the housing market crisis. So this 50-year mortgage, it has a better immediate impact on the housing market. Why? Because the family who makes $60,000 to $75,000 a year can now afford the average home in America, right? The average home, maybe $350,000. They now can afford that on a $60,000 to $75,000 salary. Of course, depending on the DTI, the other debt to income ratios that factors in, most families can be able to afford the average home around America. The cons to this is, of course, you're going to pay a lot more interest over the term of 50 years. So, of course, the amortization schedule goes from 30 years to 50 years. A lot more interest is going to be paid on that home over the course of the loan. The pros to that is that now, for those who are carrying a negative cash flow on investment properties, if this 50-year mortgage is accessible to all buyers and not just primary homeowners, first-time home buyers, or not a specific group, but all buyers, then investors can also utilize a 50-year mortgage to, again, create cash flow. The ones who have negative cash flow, create cash flow on those assets. So maybe your mortgage was $3,000 and you're only able to get $2,700 a month and rent. So now with the 50-year mortgage, maybe your mortgage payments dropped to $2,200. And now you just created $500 a month in cash flow. So there's a lot of pros to it. Another pro is, of course, the demand is going to increase. So if the demand increase, home values are going to increase. So it really will help stimulate the market right now. Of course, people are going to say, well, now it's really robbing people of their equity because equity is going to grow slower, of course. But let's look at it from a fresh new perspective. We should never limit ourselves to the minimum payment required to us by any institution. So if you're looking at an amortization schedule and they give you a mortgage payment, that is the minimum payment. That does not restrict you from paying more. So if you wanted to pay, I hear a lot of people interested in 15-year mortgages. Perfect. But I would still tell them, get a 30-year mortgage and not the 15. But set your payment schedule up to pay it off in 15 years. Meaning if your mortgage payment is set for a 30-year mortgage at $2,200 a month, but you can afford $5,000 a month payment to pay it off in 15, set your payments up to make a payment on the first for $2,500 and a payment on the 15th for $2,500. Now you're setting yourself up to pay that mortgage off in 15 years or less, right? And so if you run into a financial hardship, then you can reduce your payments down to the minimum payment, which is your mortgage payment of $2,200 if that is a scenario. And the same goes for the 50-year mortgage. The same goes for that. Just because you have a $1,500 a month payment, maybe that's what the estimated payment may be for a 15-year mortgage, right, for the same type of property. Maybe your payment is now $1,500, but you can afford to pay $5,000. Set your payment schedule up with the lender for $2,500 on the first, $2,500 on the 15th, and set yourself to pay that property off in 15 years. The same on a 50-year mortgage amortization schedule. Now, if you run into any financial hardship, in which we all know things happen, maybe there's a divorce, maybe there's a death, many things can happen that can cause us a financial hardship, and maybe we need to reduce our overhead for a limited amount of time so we can get back on our feet, and then we can start our suggested payment plan again. Well, we can reduce our payments down to the minimum mortgage payment given to us on the amortization schedule. Maybe it's $1,500. And once we get back on our feet, then we can go back and paying our $5,000 a month. So in those scenarios, look at it from a real fresh perspective. If you lose your job or something happens to you financially and you need to reduce your overhead, a lot of times we are not in a situation where we can go and refinance, right? Because maybe we don't have a job. Maybe the income is out of whack. Maybe our credit has taken a hit. There's a lot of different factors that come into the play where we may not be able to refinance at that time. But if we're in a situation where we can just revert back to the minimum amortization schedule payment, which is substantially less than what we've been paying, then we can automatically reduce it and we don't have to qualify for that reduced payment. It's already there. So I always like to recommend and tell people, use the amortization schedule or the payment schedule as your minimum payment. Don't use it as this is the obligated payment. That's the minimum payment. Always set a payment schedule up that reflects your goals and what you want to accomplish, and not pay the minimum payment. Just like on any credit card, you're not setting yourself up to pay the minimum payments on a credit card bill because, of course, you're going to pay a substantial amount of interest over the life of that loan if you don't pay more than the minimum. Same thing goes for a house, right? A mortgage. Don't set yourself up to pay the minimum. Set yourself up to pay what you can afford to pay, all right? And only use the minimum as a security factor if you have a financial hardship. Listen, it doesn't matter, my point of view. I really would like to see get you guys' take on what you think the 50-year mortgage would do to the economy. Do you think it's a good thing, bad thing? I mean, either way it goes, some people are going to win from it. Some people are going to be upset about it. But what are your thoughts? I'm Emmett Combs, your broker here, Georgia and Florida. Please feel free to drop your comments and thoughts down below.